if you are in your 30s but you haven't started investing yet, it's not too late, but you have definitely lost out on your biggest advantage, time. So this is a bit of a different video than what I normally do. I do like travel vlogs, but I want to create some value for you guys and share some of my experience. I'm not the professional investor, so this is not financial advice, but I got the question, can you tell me a little bit how you invest? So I figured I will share 13 things that I've learned here over the past 14 years or so, working in consulting, so mostly suit and tie, but not on the weekends, that I'm a little bit more relaxed. So let's start. So first and foremost, no one is perfect. That includes me. I've had a lot of investments, probably 5 that are basically gone to zero, and then maybe another 5 that are down like 80-90%. You live and you learn, and I keep those losing bets to remind myself on not doing that mistake again, because key is to make sure that you don't lose your money. You need to be able to balance risk and reward so that over time you build money, don't lose it. So for me, what does investing mean? It means make money work for you, so you are not working for money. Or another way to say it, make money while you sleep or die working for money. Because basically salary is active income, but investing can mean passive income, basically making money without actually doing anything because you put in the work before. So like I said in the beginning, time is actually the biggest advantage because investments compound over time. So I am 39 soon, but I started around 25 to experiment. Of course, I could have done it a lot faster if I avoided mistakes along the way. But if you start at 25 or even 20 if you can, that's even better, because then you have another 10 years or so, or maybe 15 even, until you get to my age, where the money is compounding, which makes a massive difference in the end. Key is basically consistency. So every month you put in a little bit of money and you don't touch it. And I think I decided to start doing that when I was around 30, which is way too late. Before that I was trying a lot of different things. So consistency is key. Every month put in money, and don't spend it, invest it. So first and foremost, even before you start investing, make sure you have an emergency fund. So I'd say like 3 months of your expenses, set aside. So if your washing machine breaks or your car breaks or you get sick, something happens, you have that, or you lose your job. You can remember some of the recent crises here in the world, things change fast. So you don't panic and have to sell your funds, because if it's like now, crisis somewhere in the world, your stocks went out 30%. You don't want to sell those to get the money. So make sure you have that set aside. And when you have that, and of course more is better, maybe 1 year, but maybe not for everyone, then you can start investing. 2 other tips I want to throw in is also, when you start investing, we haven't gotten to the different types yet, but avoid fees. So if you have to pay money to buy something, or they charge you every month, every year, try to avoid that as much as possible. Maybe impossible totally, but as much as possible avoid it, because that over time, like 30 years, will make a very big difference. So of course, like everything in life, what's measured gets managed. That goes for your health, your body, your physical health, and your money. Companies have budgets for a reason. You have a plan, you follow it. That should go for your own personal finances as well. So have a budget that you follow, don't deviate, and start investing. So going back to what I said earlier, avoiding big drops. If you invest in something really risky and your portfolio drops 50%, you don't need 50% to get back, you need 100%. And actually, if you have a growth of 7% per year, that's going to take you 10 years to get 100% back statistically. So basically, try to avoid drops. But of course, the world is like it is. Things happen. We all remember the pandemic, now there's a situation in the Middle East, and so on. So sometimes there are 20, 30, 50% drops. You need to be able to be okay to survive with that, and don't panic and sell when that happens. It's very important to have kind of a stable mind. Know that statistically this will happen, but over the course of like 30 years, it's not a problem. It's not about timing the market, it's about time in the market. So of course, you will do mistakes over time. I've done many mistakes, as I mentioned, lost a lot of money on some stocks, but also not following my gut instinct in a way. So for example, I read the book about Elon Musk like 10 years ago, literally, and thought, I want to buy that stock, but I thought at the time it was a bit pricey for me, $200. I felt I couldn't really afford that, so I didn't buy it. That was of course not a great decision, but you never know. Also Bitcoin, I was aware of for over 10, 15 years ago. My friends were in that, didn't buy it. That could have been good. So my personal feeling now is I want to have some skin in the game. So I invest a little bit in things I really believe in. Doesn't mean they will work out, but at least I can follow it and go in more later if I want, instead of sitting by the sidelines, missing everything. And one day you log in and check, wow, it's up 1,000%. It's a bit late. Nvidia I managed to catch, not as early as you could have, but at least I was part of that ride. Also, of course, when you have your portfolio, it should be a lot of different types of investments. Don't have everything sort of in one bet or in one sector. So if you have everything in tech, for an example, and there's some sort of crisis, that might go down a lot. Try to diversify. It can be different regions in the world, different industries, a lot of different ways, stocks, equity, or bonds, for an example. So make sure that if something happens, not everything goes down massively, because it's very sensitive to that. Or if you have only like oil stocks, for example, or energy stocks, you can have some more stable things like Coca-Cola, consumer goods. So those are just examples. I can do more about that some other time, but just wanted to exemplify a little bit here. Then, of course, a bonus tip here: before you actually start investing, make sure you don't have other toxic debt like credit card debt. So pay off your debts you have, if you have. Hopefully you don't have, but most people unfortunately have a lot of credit card debt. Then the emergency fund, and then you actually take the money that you're going to invest. Of course, investing means that you will take some cash that you have hopefully at hand right now and put it on the side to work for you later. So before you decide how much you're going to budget for investing, you have to question or ask yourself, what is important to me? Because lifestyle is important. I started at 25 basically from zero, because I enjoyed a little bit life sort of before that, and invested quite little the first 5, 6, 7 years. But then as my income has increased, I've been able to invest more. But instead of burning more money, spending, having fun, buying stuff, I've invested more instead. So my lifestyle has been quite stable, but what I can invest has been increasing over time. So basically, if you get a raise, take that raise and invest it. Don't just immediately get a new car or a bigger house or something like that. I'm actually trained in engineering, so of course I like math or Excel. So think of what would your ideal lifestyle look like, or realistic lifestyle. Of course, maybe everyone wants to be a billionaire, who knows? But if you say like, okay, my goal is when I'm 60 or something in 30 years, I want to have $1 million. What does that mean? Now, of course, you can just ask ChatGPT, you will get the answer. How much do I have to invest every month to get to $1 million? I actually asked that, and depending on the interest rate, basically, let's say you start at 35, so at 65, I want to have $1 million. You don't have anything right now. Depending on the interest rate, if you invest between $400 to $1,000 per month, you get to $1 million in 30 years, with the return varying between, I think, maybe 5 or 10%. You can try it for yourself. Of course, that can sound like a lot of money. I could definitely not invest $400 per month when I started out, just be clear with that. But if you know that, then the second question is, how can I increase my income in my job so I can do that? Because then it's basically just a game of doing it over a long time. So of course you need to have income, money at the first time. This is more investing. So once you have money, how to invest it and make the money work for you, so you don't have to continue working hard forever. Also, on the topic of time, this will probably change. So when you're younger, you maybe have a bigger risk tolerance. You don't need the money right now. You need it like in 30 years or maybe in 10 years, because you're going to buy a house. So you can have more volatile investments like stocks. But as you get older, typically you shift to maybe less volatile assets with lower returns, like bonds, basically, government loans or company loans, basically, that have a fixed interest and they change a lot less. So for example, right now the markets are very volatile. Stocks can jump like 5-10%, in a day or a week, maybe 5% the past week, but the bond market is maybe 1/10 of that. So if you can't take that kind of volatility, bonds could be one thing. But I would say start with high risk and more volatile investments when you're a bit younger, and then you can have bonds. And of course you can have a bit of a balance there. So if you know that you will need this money in 3 years, maybe you have a bit of that in bonds, so you can at least sell that, but the rest you have in stocks. So it will change kind of the characteristics of your portfolio will probably change over time as you get older and more experienced. Of course, a bonus tip here related to investing, but how you manage your own expenses, this you can probably talk about for hours. But I started tracking my expenses pretty much the same time I started investing, actually earlier than that. So every month I track exactly where my money goes, so I know what I spend and how much, and then I have a budget, how much left, right? So I get this much for my salary per month, this much I burn, here's the remaining part for investment, and you don't deviate for that, and you can track that. So I've been doing that for almost 15 years. Then if there are some trends you probably need to address, you're eating out too much or something like that, and then you can reallocate that later on. So basically, keep it simple, I think. Have a certain amount or a percentage every month that you invest. You have a clear strategy. For me, I've automated it on my online brokerage. I can maybe talk about that later. But basically, every month this much is deducted. It's invested in these assets, and it happens every month. no questions asked. So I know, okay, in 12 months and a year, this will happen, I will have this much in the end, and you just do it. Not exciting, but gets the job done. So I think some closing remarks here. It's not about being perfect, it's about starting and not having sort of paralysis by analysis, thinking too much, what's the best fund, what's this, what's that. Of course, it depends on where you are in the world, what options you have, but start looking into this, start trying. You don't have to, take all your money or your cash at once. Try a little bit over time, and then hopefully you figure out the good strategy. But make sure you don't do crazy things that you don't understand. I would say good rule of thumb is like, understand what you're actually investing in. Do I know these type of companies or assets? Don't just read online on forums and put everything in crypto assets or energy or whatever because someone says this will go this way. It's probably better to invest something that feels good. For me, I only buy investments in companies that I really feel like, okay, I want to hold this forever. I'm going to buy it and I'm not going to sell it. And that is the plan. I have some index funds, things like that you can sell. But if you talk about individual investments, I basically buy them and never plan to sell them. So with that, I think I've covered a lot of different things here, maybe even more than 15 points. Let me know if you have any questions or comments. As I said, I normally do travel vlogs, they're very different, but investing and personal finance and fitness are some of my favorite topics in life. Maybe it sounds boring, but to me, very interesting. So let me know what you think and have a great day, everyone.